One pattern has been used for over 100 years to predict major trend reversals, and once you learn how to spot it, you'll start seeing it everywhere. Alright, and in this video I'm gonna teach you and explain you how to identify it, where most traders mess up, and the one confirmation signal you need. Alright, so let's break into it. Is head and shoulders pattern. So we have three parts, okay? The left shoulder, so this is the left shoulder because like here, high pullback, okay? Then we have the head. So in this head we have a higher high, okay, because we are making higher high, and a deeper pullback, okay, and the right shoulder, so lower high, okay, and a lower pullback too. And this is shaped, so this setup is shaping in three parts, okay, that's why. And what we are calling neckline is the line which is connect the two pullbacks lows, okay, so just over there and over there. And this pattern not confirmed until price breaks below neckline. So right there we have a real confirmation, and is only at this point that this setup is confirmed. And the psychology behind this setup is that on the left shoulder we have just a continuation of the trend, alright? Then on the head we have this last push by buyers, okay? And on the right shoulder we have just a failure, and momentum is dying, and it will die even more after when we are breaking this neckline to the downside. So what makes a valid head and shoulders, okay? So the symmetry helps but isn't required, just in case, just to let you know, okay? But one of the most important thing is that, of course, as usual, the volume. Highest on left shoulder, okay, or even on the head, and noticeably lower volume on right shoulder. Alright, then upward sloping neckline is actually more bearish when it breaks, okay? So when the pullback of this right shoulder is above the pullback of this left shoulder, that's would give us an upward sloping neckline, and that's why it's actually more bearish when it breaks, because there's more long to squeeze, and if there are more long to squeeze, boom, the downside move could be more important, and that's why this setup could work even better when the neckline is in an upward sloping. And the last point that makes a valid head and shoulders is that it must form at the end of an uptrend. In the middle of a range, it's just unreliable. And how to trade this setup? So if you want to have a conservative approach and a conservative trade, so just short on clear close below this neckline. So in this example, it would be below this candle, at the close of this candle, when we are clearly breaking it to the downside, okay? Or on the retest of the neckline from below. So just in case if we have a nice pullback, boom, okay, over there you can short it. But then all the other entry would be aggressive. So if you want to have an aggressive approach, short when right shoulders forms and you see failed higher high, okay? So over there, if you had a nice levels that the market could reject, and you're just seeing sellers stepping it into the markets right there, and big red candles, so why not try to short over there, okay? And that giving you even a better risk reward but a lower win rate. Your stop loss must be above the right shoulder, so just right there, okay? And the target distance from a head, so the target it would be from a head to neckline. Then you projected to the downward from neckline break, okay? And it's giving you your target. Let's see some new examples. So right there on this market, by the way, it's the GBP CHF. So we have a nice in an uptrend, okay? We have a nice left shoulder, head, right shoulder, and boom, we are breaking it to the downside. So if you're just taking the head to the neckline and you project it at the breakdown, it's giving you the same target. Or even not, it's giving you the same target, but later we are just reintegrate it and boom, coming back, okay? So that's why put your stop above the right shoulder is very important, because the market is not always with a nice price action. Sometimes it could be choppy, and this market is a bit choppy. Perfect example that you have to respect your stop and your target. Another example right there. So we have a nice bullish move, the left shoulder, the head, and this is just a small right shoulder, okay? But you have to connect to shape the neckline, the pullback of this left shoulder, and to connect it to the right pullback of the right shoulder. Boom! We are breaking it to the downside. We are doing a retest on this neckline, and perfect. There was a perfect area to take a short right there and put your stop just above this retest, okay? So and you're gonna say that yeah, but we are pricing above this right shoulder, okay? But you know, it's not everyone a textbook case, okay? Sometimes the market just is more just technical, and this is a technical market right now, and you could take a stop, you know, but then this setup is still working, and that's why when we are just rejecting this neckline, boom, it could worth it to take a short, test it, put your stop just above this retest, and bam, we are just doing this new trend to the downside, okay? And your target is gonna be hit. Another example. Let's see on this one, left, so a bullish trend, left shoulder, head, right shoulder, we are breaking it, boom, take a short, place your stop above the right shoulder, you're taking this high, project it to the break, and it's giving you easily your target. And after the neckline breaks, price often retests it from below. And this retest is the highest probability entry, okay? With best risk reward and clearest invalidation. To warn you guys, not every head and shoulders retest, okay? Not everyone. It's a probability world trading, okay? So some break hard and never look back. For example, this one, okay? Just break it down and never pull back, and some are just staying choppy, retest their neckline and then walk later, okay? One of the common mistakes is that the first one, shorting before neckline breaks, okay, right there, or even right there at the retest. The pattern is not confirmed until then, okay? So it's at your own risk. Or another mistake is that seeing head and shoulders everywhere needs real uptrend context, okay? It's only in a bullish trend, okay? And not in a range, or even not in an bearish trend, all right? Well, another mistake is that in your ring, volume on right shoulder, so until the shoulder, okay, if the volume are not getting lower during the pullback and increasing during the break, it could be a trap. So that's why high volume means buyers stepping back in and possible failure of this setup. All right, so volume is really important. And the last mistake is that setting targets too ambitious, okay? The market is working by a fractal, and that's why if you just draw the line from the head and neckline and project it to the break, is giving you a real nice target, which is very logic. So to recap this pattern and this video, failing momentum plus declining volume plus this neckline break after the right shoulder, and boom, wonderful head and shoulders to take and to enjoy on your trading. All right, so that's it for this video, and in the next one I'm going to talk about the inverse head and shoulders. So for that, make sure to subscribe to this YouTube channel, and because I'm gonna post a lot of educational content and even entertainment content later, and like the video if you liked it, of course, and see you in the next one or in the next live stream on Phineas Prop Film. It was Florian, bye bye bye!
Yo, his name is Florian, he's the NASDAQ hustler. Every day he's grinding, making all them numbers cluster. He's a day trader, living life as a thrill seeker. Analyzing charts, he's the Wall Street sneaker. 9 to 5 ain't his game, it's the stock market flow. Tickers on his mind, watching those numbers grow. Buy low, sell high, that's the name of